Hey everybody, hope you're doing great today. In this video, I'm going to talk about real estate investor fraud. So there's still some resistance to believing that we are currently in a housing bubble, and there's resistance believing that we are going to see a correction. Now, when that correction happens is anyone's guess. Timing the market is never easy. Most of us, if we could time the market perfectly, we'd be sitting off in some beach somewhere enjoying the great life. But for the rest of us, we need to look at the data, we need to look at the facts, and what's going on with the real estate market. So in this video, I'm going to talk about real estate fraud, how it impacted the 2008-2009 housing crash, and how we're seeing real estate fraud occurring now, which could also result in the housing market going down. So let's start off by looking at 2008. So 2008, in the past, the housing market did go down after experiencing a large bubble. Primarily, interest rates were held low artificially for a while, and that resulted in a lot of buyers bidding up houses, multiple offers, people lining up around the block to get a look at a house they wanted to bid on, and we saw the after effect of that bubble popping. Many homes went into bankruptcies, short sales of homes also became a new thing. But a key point to look at is that there was fraud in that mortgage market. During the 2006 through 2008 housing market, there was investor fraud, there was owner-occupied fraud, so enough fraud to go around that did impact the housing market. Here's a mortgage fraud report from 2008 at the FBI.gov website. Basically, this report updates a 2007 mortgage fraud report and addresses current mortgage fraud projections, issues, and identification of mortgage fraud hotspots. They state that this report is based on FBI, state, local law enforcement, mortgage industry, and open source reporting. They also get information provided by other government agencies such as HUD, Federal Housing Administration, Internal Revenue Service, Postal Service, as well as various other financial entities. So here are some of the key findings from this report. Mortgage fraud continued to be an escalating problem during the 2008 timeframe. They note the downward trend in the housing market during 2008 provided a favorable climate for mortgage frauds to proliferate. They mentioned several of these schemes have the potential to spread if the current economic downward trend continues into 2009 and beyond, which it did. So they note an increase in foreclosures, declining house prices, decreased demand also placing pressure on lenders, builders, and home sellers. Some of the victims of mortgage fraud activity are noted to be borrowers, mortgage industry entities, and those living in neighborhoods affected by the mortgage fraud. So basically, if a house is forced into bankruptcy because an investor, buyer, whatever, engaged in fraud, they can no longer afford the mortgage. That house now is vacant, abandoned. It sits in that vacant status for a while. It can degrade over time if nobody's occupying it. Squatters can come in, which results in overall other homes in the close by area declining in value. In this report, they talk about some of the common schemes that they saw in mortgage fraud. So things like reverse mortgage fraud schemes, credit enhancement schemes. With credit enhancement schemes, they note that loan officers, home builders are taking measures to encourage borrowers to add their names to people with good credit, either add them to accounts, bank accounts, credit accounts, that way temporarily boosting their credit score and giving them an artificially higher credit number, allowing them to borrow more and borrow for a lower interest rate. They mention a number of builder bailout schemes, doing condominium conversions, pump and pay, basically paying an appraiser to increase the value of the home, allowing it to appraise higher, be purchased for more money when it's actually lower in value. They note foreclosure, rescue issues such as arson. Basically, people are going towards foreclosure. They know when they're falling into foreclosure, so rather than going through that process, suddenly the house burns down, they can make a claim on insurance and pay off the mortgage as well as walk away. They had other issues with loan modification schemes. Property flippers were also causing issues, illegal property flipping. They note perpetrators are taking advantage of distressed housing market and repeatedly flipping the same property numerous times. And they also discuss short scale schemes as part of those fraud issues. So fraud existed in the 2008 housing market. What was that impact of fraud? Here we have an article from LaSalle University published in 2016, and it's entitled How Mortgage Fraud Helped Facilitate the 2008 Housing Crisis. They note here the implosion of the housing market certainly did not happen without warning signs. The warning signs showed the market was on decline back in 2006. They note an increase in foreclosures that began in 2006, leveled off in 2008, and hit an all-time high in 2010. So here's some of the primary causes of the decline in the housing market. They note subprime mortgages, basically where mortgages are being offered to those with credit scores lower than your typical borrower. Another thing were mortgage-backed securities that cause problems. What that allowed lenders to do is give a mortgage to pretty much anybody, but then package those mortgages into a security type of stock, so to speak, and sell those securities off to somebody else who purchased that investment for a cash flow investment. Entities like pension funds, insurance companies desire those types of investments so they have a steady flow of cash. So whereas they can take a lot of high-graded mortgages and package them, sneak in some low-graded mortgages with those mortgages, the buyers usually aren't checking each individual mortgage. They're looking for the overall average of mortgages to be on a better grade. Sneaking in a few lower quality ones, the issues you have later is as those start defaulting, that does impact everything else because the overall value of that security then is going down. It should be noted that currently the Federal Reserve has stopped buying mortgage-backed securities, but in the past couple of years, they've been buying a number of mortgage-backed securities, which has also helped to artificially lower the mortgage interest rate, which has caused a lot of influx of investors who see a lower mortgage amount, higher rent, skim that difference, and use that as a profit. Especially when the market interest rates are low, people are looking for ways to earn a return on their dollar. They also note that bond rating agencies help to facilitate selling of some of these mortgage-backed securities, which weren't necessarily a great deal, and in the end end up costing a lot of investors money. In concluding, they note the high stakes and risky behavior of Wall Street investors gambled with America's future with devastating consequences. This systemic fraud was widespread and involved lenders, attorneys, mortgage servicers, and appraisers. The all-around bad apples in the housing industry were causing issues that ultimately impacted everybody. Some lessons learned from this report is years of house prices increases are not always a good thing. Homes should not be looked on as a family's only investment. Homes need to be viewed as liabilities, not assets. Terms of homes should be viewed as liabilities, not assets. If your home is something that you're living in, I highly agree with that because it's not cash flowing. It's not like you put money into that home and like if you were to go purchase a stock that's paying a dividend, you're getting money back on a regular basis, quarterly basis, monthly basis, whatever have you. And you may even get some appreciation in that stock if it's a well-run company. Your home, on the other hand, you're putting money in to replace a roof, to update the furnace, to paint the walls, change the carpet. You're not getting money back from that unless it's a rental property. If it's a rental property, that's a different story. But in case of an owner-occupied home, it's not an investment. It's your home to live in, and that money you're going into is just going into the maintaining the house. So let's look at the current market. We're here in 2023. I've got a report from the Federal Reserve Bank of Philadelphia, working papers, their research department, owner occupancy fraud, and mortgage performance. It's published in January 2023. It starts off, we identify occupancy fraud, borrowers who misrepresent their occupancy status as owner occupants rather than investors in residential mortgage originations. So basically, if you state you're going to owner occupy the home, you can get a mortgage that's in the 2 to 5% down, even 0% down if you qualify for a VA mortgage or the property qualifies for a USDA mortgage. So in those situations where an investor has very little skin in the game, basically they put down very little money. If the cash flow starts going negative, if there's another issue, suddenly the roof has a lot of damage, they need to spend $20,000 to repair that roof, but they don't have enough reserves, they don't have enough cash flow to cover that, it's easier for them to walk away, ignore that property, send the keys back to the lender, let it go to foreclosure, and not worry about it. Now, of course, the problem with that becomes is the homeowners in the neighborhood, if there's a tenant in that property, a long-term tenant or a medium-term tenant, and their roof is bad, it's leaking, it's causing damage inside the house, they can't live in the house, that it definitely impacts them. The homeowners surrounding the property, they'll be impacted as the value comes down. A home that has a leaking roof, if not repaired immediately, you're going to suffer mold issues. There'll be wood rot issues. As that builds up over time, the structure of the house will start to degrade, and that house could basically become unlivable. Here, the Federal Reserve report notes, these fraudulent borrowers perform substantially worse than similar declared investors, defaulting at a 75% higher rate. Their defaults are also likelier to be strategic, suggesting that they pose a risk in the face of declining housing prices. Strategic meaning if you put down 25% on a $300,000 real estate investment, whether it be a single family house, whether it be a multifamily, whatever, so 25% on a $300,000 house, that's $75,000 out of your pocket, cash you needed to put forward in order to purchase that house. So you're less likely to want to walk away from that because that's a big chunk of change versus the investor who's only put in 2 to 3%, less than $10,000 in some cases. It's easier to walk away from that. So with owner occupancy fraud, the investor is saying, yeah, I'm going to occupy the house as a owner occupant. Basically, I'm going to be living in the house, when they in fact never plan to do that. And most mortgages allow you to say, yeah, I'm going to owner occupy it for a year. After a year, if you decide, I don't want to live here anymore, I want to sell the house, or I want to turn it into investment property, that's fine, you can do that. But from the get-go, stating that you're going to owner occupy the house, but you never owner occupy the house, and you applied for a mortgage based on that owner occupancy, that is considered fraud. And you could be sued and face criminal and civil penalties on that. Some of the real estate gurus, real estate coaches actively suggest that strategies, basically saying you're going to owner occupy it in order to get the lower interest rates, in order to get the lower down payments, but in the end just turn it into investment property. In concluding, the Federal Reserve report states, we identify widespread occupancy fraud in residential mortgages, both during the housing bubble and also in recent origination vintages. In contrast to previous studies, we were also able to show that occupancy fraud was common in the GSE, government-sponsored entity market, and in loans held in portfolio, not just private mortgage-backed securities, MBS. We find that mortgage borrowers who misrepresented their occupancy status perform worse than other similar declared investors. Important to note is they state our results are economically significant and suggest that such fraud may also pose a risk to future boom-bust cycles. One area for future research is understanding whether behavioral characteristics may help explain why some borrowers were led to speculate in the housing market through fraud. Basically, they want to figure out, why are people committing fraud? I think they need to do a little introspection. With the lower interest rates offered by the Federal Reserve, banks were offering less on savings accounts, CDs. Treasuries were not offering as much. Now that treasuries are in the 5% range, investors who do have spare cash and who do have a low appetite for risk are more likely to go invest in things like CDs, treasuries, savings accounts, versus in the past, when you're getting 0%, you're getting nothing on those. That's going to cause an issue for somebody who has cash and they're just looking for a safe return on investment. So this type of fraud you're going to see in a number of different types of investments. Those who were in the short-term investments, the Airbnbs, the VRBOs, same type of thing. They state, hey, we're going to owner occupy it to get a lower interest rate, to better mortgage terms, but instead they turn around, they start renting it out to whoever. So it looks great on paper for them, it helps them save money, but in the long run it's hurting everybody else. This is not only happening with single family homes, it's also happened with multifamily homes, anywhere between 2 and 4 units. You can buy a home as owner occupied. You can say, hey, I'm going to live in one of the units, rent out the other 2 or 3. It's called house hacking. It's a legitimate way to do it. Basically, you go live in one of the units, live in there for a year, prove the units over time, and then after a year you can move out and do it again. So that's legitimate. That's written within the terms of the mortgages. You're allowed to do that, and there are people who are doing that. On the other hand, the fraud of buying it and claiming you're going to owner occupy, but you never owner occupy, hurts others. You're competing against those who actually do want to occupy the house, who do want to live in the house. There are other issues as well with Airbnb investors who were investing. They purchased using 2020, 2021, 2022 metrics. We were just in lockdowns due to a virus, and as a result, once those lockdowns ended, people wanted to go out, they wanted a vacation, they had free stimulus money, and so that increased the spending, that increased the travel. End result is that money is drying up now. A lot of that stimulus money is gone. People have satisfied their need to travel. They're sticking home. And especially as we're entering a recession period, people are going to be traveling less. So a lot of those Airbnb investors are going to be facing some uphill battles, and they will start to sell. Those who might have purchased their home with occupancy fraud might even just walk away, hand over the keys. So that's going to cause a number of issues for the housing market in general. So that's all I have for this video. Please hit that like button if you found this to be informative. Thank you again for watching, and I'll see you in the next video.